Assalamualaikum warahmatullah and good morning. In the third video, within the topic of complete accounting cycle for service business, we will look into the preparing closing entries and the post-closing trial balance. Okay, so at the end of the accounting period, the company makes the accounts ready for the next period. Okay, based on what we have mentioned in our previous lectures, that the business make the assumption of time period. Okay, the business will break up the time into period so that they will make their reporting. Okay, they will look into their performance based on time periods. Okay, either monthly time period or quarterly time period or yearly time period. Okay, therefore, because their accounts should show the performance based on period, therefore when one period ends, they need to start afresh with a fresh accounts. Okay, and so for example, if they have done their business in 2019, okay, in 2019 they have a lot of revenue and lot of transactions for expenses, and then they enter into 2020, which is a new fiscal year for them, so they need to start afresh. So in 1st of January, they will have no transactions regarding revenue, no transactions regarding expense. Therefore, they need to start afresh. So for them, in order for them to start afresh, they need to close the accounts of the previous period and start with a zero balance in the following period, in the new period. Okay, but we will show you that not all of the accounts are closed. Okay, so there are two categories of accounts. There are the temporary accounts and there are the permanent accounts. Okay, so all revenue accounts, all expense accounts, and all the owner's drawing account are temporary account. Why do we say it is temporary account? Because they all relate to transactions of that particular period. Okay, we want to look at when we want to evaluate the performance of a company, we will look into the a certain period. In year 2019, how are they doing? So in the account, the revenue accounts will show all of the transactions in 2019. Okay, but when we go into 2020, all of the transactions in 2019 is no longer relevant. We don't count that anymore. Okay, therefore, we need to close the revenue account and start afresh in 2020. Similarly with the expense accounts and also the owner's drawing account. However, there are some accounts which are permanent accounts. Okay, there are the asset accounts, the liability accounts, and the owner's capital account. Okay, because asset, if you have a car in 2019, if you don't do anything to the car, you will still have that car in 2020. You will still have that car in 2021, 2022. So therefore, you don't close the account for the car. Okay, because once you close the account for the car, it's as if you lose the car. The car is no longer yours. Okay, therefore, similarly, when you have liability. Okay, you owe your bank. In 2019, at the end of 2019, you owe your bank. If you don't pay off your bank loan, in 2020 you will still have that balance. In 2021 you still have that balance. Therefore, you don't close your liability accounts. So similarly with owner's capital, the owner invests money in the business, not for 1 year, not for 1 month, but for the rest of his life even. Therefore, we don't close the accounts of the owner. Therefore, there are some accounts that will be closed, but there are some accounts that will still be open. Okay. Right. Therefore, we need to do closing entries. Okay, preparing closing entries. Closing entries formally recognize in the ledger the transfer of net income and owner's drawing to the owner's capital. So we know that owner's capital account is a permanent account because the owner still owns the company throughout the company's life. Okay, but what will happen is that the owner's capital will increase due to profit. Okay, when the company makes profit, then the owner's capital will increase. Therefore, what we need to do is we need to transfer the net income and transfer the owner's drawings to the owner's capital. Okay, so this is in essence, in general, what closing entry means. We are transferring the income and the owner's drawing to the owner's capital. So companies generally journalize and post closing entries only at the end of the annual accounting period. Okay, so usually companies only close their accounts at the end of the annual. Okay, not they seldom close every month. They usually close the accounts at the end of every year. Okay, at the end of the year of the fiscal year. Closing entries produce a zero balance in each temporary account. Okay, so when we close the account, when we do the closing entries, the resulting effect of that is that all of the temporary accounts will start off being zero. We'll have a zero starting balance. Okay. So this is a graphical illustration of what happens when we prepare closing entries. Okay. We have all the expense account. Okay, the expense account is debit, has a debit balance. Okay, so to close that account, we need to credit the expense account by the debit balance. Okay, by the debit balance, and we do a debit on the expense account to close the expense account. Because the expense account has a debit balance, to close it we need to credit the account. Okay, so once we credit the account, the opposite side is a debit. We need to debit on a temporary account. The temporary account is called income summary. Okay, so income summary summarizes the net effect of the revenue versus expenses. Okay, so actually I told you the second step. The first step is that we have the revenue accounts. We have the individual revenue accounts with the balances, and revenue accounts have credit balances. So in order for us to close the revenue accounts, we need to debit the revenue account. Okay, revenue accounts have credit balances. To close those accounts, we need to debit. We need to do the opposite of the balance. So we credit the revenue account. So what do we debit? We debit the revenue account. So what do we credit? We credit the income summary account. So we have a credit, debit on the revenue account, credit on the income summary account, the same amount. And then we have the expenses. I've talked about that step before. The third step is that we find which side is more than the other. Okay. So we total up the income summary account. Okay, generally, if a company is making profit, they will have a credit balance. The credit balance of the income summary is more than the debit total. Okay, the total credit is more than the total debit. Therefore, the discrepancy of the debit is showing the net income. So to close the next step is to close the income summary account and transfer that into the owner's capital. So the difference, if the debit side is more than the credit side, then we need to credit the income summary account so that we have a total balance, similar balance on debit and credit. So we debit the income summary account and we credit on the owner's capital. So we know that owner's capital is a credit side account, okay, a credit balance account. So if we do another credit, then it increases the owner's capital. Why did it increase? It increased due to the net income. So if the company is making loss, then it will be to close the income summary will be to credit the income summary and to debit the owner's capital. Okay, opposite if it's a loss. But if it's an net income, then this is the way. So the owner's capital account will be increased while the income summary account will be closed. And fourthly, we need to transfer the owner's drawing. Okay, if you look here, close dividends to retained earnings. This is probably a little mistake from the publisher of the book. This is relevant. The number 3 and number 4 is relevant for corporations. We are just looking at here. We are looking at sole proprietary. Okay. Anyway, the fourth step is to close the owner's drawing account. Okay, so owner's drawing account is a debit balance account. So to close a debit balance account, we need to credit that account. So we credit the owner's drawing account. Therefore, we transfer that balance by debiting our owner's capital. So what is the effect of debiting the owner's capital? It will reduce the owner's capital, because when the owner makes drawing, it reduces the amount that the company owes the owner, because the owner have taken something from the company. Okay, so these are the steps in preparing closing entries. Firstly, we close the revenues account by debiting the revenue account and crediting income summary. Secondly, we close the expenses accounts by crediting the expense account and debiting the income summary. Thirdly, we close the income summary account by transferring that balance into owner's capital, and depending whether the income summary is a net income or net loss, so we will debit or credit the relevant side. So if the income summary is making a net income, therefore the credit side is more than the debit side. Therefore, we debit the income summary and transfer the income net income into owner's capital by crediting the owner's capital. And then finally, we transfer the owner's drawing into the owner's capital by so we close the owner's drawing account by crediting owner's drawing and debiting owner's capital. Okay, so this will be the journal entry. Okay, the first step is closing the service revenue. Therefore, we debit service revenue 10,600 and we credit income summary. That is what is going on in this one. Okay, we debit revenues account and we credit income summary. Okay, second step is we credit all of the expense account. If you see here, we credit all of the expense account of their balances. So we credit supplies expense, depreciation expense, insurance expense, salaries expense, rent expense, and interest expense. We credit all of the balances here, and then we debit a total of those balances. Okay, so we total up so we credit all the balances of the expense accounts. So and the total of the credit is 7,740. Therefore, we debit income summary account by 7,740. So after looking at step 1 and step 2, we will find that the owner's summary account will have a discrepancy of 2,860. Okay, debit, because we have debited 10,600 and we have we have credited 10,600 when we have debited 7,740. So the difference is 2,860. So to close the income summary account, we need to debit 2,860 from the income summary account, and that debit we transfer into the owner's capital by crediting the owner's capital account by 2,860. Remember, all the debit credits must equal. Okay, so each transaction, each step must have an equal total debit and total credit. So this one is equal to this one is equal to that one. Okay. The fourth step is to transfer the drawing. Therefore, we close our owner's drawing account by crediting the owner's drawing and debiting the owner's capital. So those are the closing entries. Okay. So and summarized through this illustration. Okay, these are the accounts. Okay. So these are the accounts. So this is the service revenue account and the income summary here. So the first step, this is the first step. This is the first step. These are based on the transactions before. Okay, what we have recorded before we close all of our accounts. Okay, we have a debit balance of we have a credit balance of the service revenue of 10,600. To close it, we debit 10,600 and we credit our income summary account of the same amount. Okay, and then we have all of the individual expense accounts. All of them have certain debit balances. Okay, so to close those accounts, we will credit those accounts. So here we have an original balance of 1,500. To close it, we credit 1,500 here, we credit 40 here, 50 here, 5,200 here, 900 here, and 50 here. We credit all of these accounts with the appropriate amounts, and we debit a total of them of 7,740. So when we compare the debit side and the credit side, 10,600 on the credit and debit side is 7,740. The difference is 2,860. Therefore, the difference we need to close income summary, we debit by the different amount. Okay, the difference in the amounts. So we credit 2,860 in income summary, and we debit in income summary by 2,860, and we credit owner's capital by 2,860. Okay, so because of that, it increases the balance of the owner's capital account. And the fourth step is that we have an owner's drawing balance of 500. To close it, we credit owner's drawings and we debit owner's capital. Okay, so that's the illustration of how we post closing entry. So here it summarizes all of the steps. Okay, first step, second step, third step, and fourth step. Now this one is right. Okay, the previous in the previous slide, the publishers were mistaken. Okay, so once all the accounts have been closed, we will prepare the post-closing trial balance. Okay, so what is post-closing trial balance? The post-closing trial balance will populate the balances of the accounts after all of the accounts have been closed. Okay, so remember the kinds or the types of accounts that we have closed are the expenses accounts, the revenue accounts, and thirdly the drawing account. So when we prepare the post-closing trial balance, we will find that there are no more expense account, no more revenue accounts, no more drawings account. Okay, so this is the post-closing trial balance. We will find cash are assets, it's an asset, accounts receivable is an asset, supplies an asset, prepaid insurance is an asset, equipment is an asset, accumulated depreciation is a contract account. Okay, notes payable is a liability, accounts payable is a liability, unearned service revenue is a liability, salaries and wages payable is a liability, or interest payable is a liability, and owner's capital is an owner's equity account. Okay, because we have closed the accounts and transfer the balances to the owner's capital account, therefore we will find that the owner's capital account has changed. Okay, this is not the same as the pre-closing trial balance. Okay, the adjusted trial balance has an owner's capital of 10,000. Remember in the worksheet, but after we close all the accounts and transfer all the income and the drawing, we will find that the owner's capital has changed. Okay, has increased in this case.